Good night, Ms. Bahor. Thank you for joining us, Group 2, as we present our study on financing choices. The members of our group are Glenn Martin, Javon Mitchell, Nikisha Matthew, and Crystal Gopi Singh. Money is needed to help all businesses get incorporated, keep maintained, achieve growth, and most importantly, survive. Without adequate financing, a business owner's dream of having a business is just that, a dream. While there may be multiple ways to finance a business, it is important that businesses be realistic about their current position and attractiveness to potential financiers. Only then will they be able to save time and resources when seeking financing. For this study, we will be presenting the financing choices of some firms with an analysis of why financing differences exist between each. Specifically, we will be looking at 1. Sole trader versus a conglomerate. 2. A family firm versus a non-family firm. 3. A firm in the startup phase versus an established venture. 4. A social enterprise versus a commercial enterprise. I will now pass you on to Nikisha for further analysis.
Financing choices of a sole trading firm include term loan, personal assets, business grants, and business credit card. Financing choices of a conglomerate includes loan through parent business, through company assets, and sales of shares. You may choose the financing choices that are appropriate for your business by knowing what you need the money for and how much you can afford to pay back. Usually, the individual proprietor who owns the business will provide the funding. To start the business, they could borrow money from friends and family or use their savings. This prevents the sole proprietor from incurring debt at the beginning of the business. Conglomerate-owned and managed businesses frequently have access to finance through the parent business, allowing them to invest in their long-term expansion. Smaller businesses may not receive favorable conditions in loan facilities from banks and the capital markets because of their erratic or inconsistent sales and profitability performance. When this happens, the parent firm can step in and provide a subsidiary with much better conditions than the markets might otherwise be able to provide, like a reduced loan rate. As a sole proprietor, there is no distinction between personal and commercial assets. Therefore, any debts incurred in the business structure are your sole responsibility. In contrast, the company in a conglomerate is accountable for all business debts. A firm may own assets or property, and this property or asset belongs to the company, not the shareholders or the directors. These assets might be sold by the business to assist pay.
My name is Glenn Martin. I will be presenting on the financing choices of a venture that is considered a family firm compared to a non-family firm. Sources of finance usually takes both approaches, both internal and external financing. Internal financing is a type of self-sufficient funding. So example, in the early stages, you may use your personal savings. And as the business moves along, the business cycle, the type may change. So example, in the maturity stage, the family venture may find itself selling off assets or utilizing retained earnings. In the early stages as well, the family may pool their savings together as a source of the internal financing. Expansion of the business usually takes the route of debt financing. Debt financing is where you borrow money to finance the business. You agree to pay back the creditor the amount you borrowed as well as interest. And the exit strategy is, pretty much is passed on or passed down to the next generation or the next person in line. Financing options were available for a non-family venture. The sources of financing, both internal and external. External financing are funds obtained from outside the firm. An example would be equity financing, where you raise money by selling shares to an investor for part ownership in the business. In the early stages of financing, the entrepreneurs or the investors, they can take advantage of their credit. They can also utilize arrange bank overdrafts as a source of the early financing. When it comes to expansion and additional financing, they take advantage or they can use, debt and equity or debt or equity financing. Debt equity being loans and equity financing being venture capitalists and angel investors. A venture capitalist is a private equity investor that provides capital to companies in exchange for some level of ownership. And the exit strategy is pretty important as well. It would play a role in the financing options. Example, the family venture, the succession plan is to pass it down to the next generation in most instances, or the next in line. With the non-family ventures, when an investor decides to part way after he receives his desired return on his investment, he may look to sell off his shares, and the existing partners, the existing members may need to pull together funds to purchase his shares. So it's also an interesting and important part of financing options for the non-family venture.
We will now look at and evaluate the financing choices and the reason for differences in financing choices for a firm in startup phase versus an established company. The financing choices of a firm in its startup phase are as follows. 1. Personal financing. This is a way where the entrepreneur or entrepreneurs use their own cash to fund the startup of their operations. 2. A gift or loan from a family or a friend. This is where a close relative or friend gives some amount of money to fund the business without expecting anything specific in return. 3. Crowdfunding. This is a way to raise money from a large number of people who contribute a relatively small amount, typically via the internet. 4. Angel financiers. These are people who provide capital for businesses in the startup phase in exchange for convertible debt or ownership equity. 5. Government grants and subsidies. These are financial awards given by governments to startup businesses to help promote economic growth. And finally, 6. Small bank loans. These are a common source of finance for small businesses, accessible via financial institutions. They are a quick, straightforward way to get a lump sum of cash to be repaid in fixed monthly installments over a period of time. Next, we will look at financing choices of an established venture. 1. Retained earnings. This is where a company invests some of its profits into the business to fund its operation or achieve growth expansion. 2. Debt capital. This is when a company borrows money to be paid back at a future date with interest. 3. Equity financing. This is where the established venture raises money by selling company shares either to existing shareholders or new investors. Next, we will look at why the financing choices of a firm in startup phase differs from that of an established venture. Now we will look at why the financing choices of a firm in its startup phase differs from that of an established venture. Firms in startup phase entails investors making risky investment due to little or no financial records. However, the financial records of an established venture may give assurances to investors, prompting them to offer financing. 2. Startup businesses may require small amounts of money, which could be loaned or gifted by persons around them, as opposed to established firms, which may require access to bigger sums of money only accessible via financial institution. Firms in the startup phase may not be able to afford extra expenses such as interest rates that come with big bank loans, while an established firm may need to engage in debt financing to build a credit history. Firms in the startup phase may not have equity to leverage with for financing, as opposed to an established venture which may have business shares that can be issued and sold to investors for financing. I will now hand over to Javon as he discusses financing choices of a social enterprise versus that of a commercial enterprise.
A social enterprise refers to a business with certain social objectives as its primary goal while using a commercial structure to run the organization. Social enterprises usually attempt to make a strong societal impact while maximizing their profits, which is then used to fund their social programs. A commercial enterprise means any for profit activity formed for the ongoing conduct of lawful business, including but not limited to a sole proprietorship, a partnership, a holding company, a joint venture, a corporation, a business trust, or any entity which may be publicly or privately owned. A commercial enterprise is a firm that is primarily involved in the production and selling of goods and services for attaining profits and income. The financing choices of a social enterprise. First, we have grants, and a grant is a way that the government funds your ideas and projects to provide public services and stimulate the economy. The next way is by having donations, and that could be by raising funds or by asking persons to donate. The next way is by project funding, which is the funding of long term infrastructure and public services using a non recourse or limited recourse financial structure. The debt and equity used to finance the project are paid back from the cash flow generated by the project itself. The other way is by bank loans, which is pretty straightforward. You go to the bank, you apply for a loan, and they grant it to you, and you use it to fund the project. The financing choices of a commercial enterprise. One, we have by retained earnings, which are profits or income that has been stored away by the company to be used later for reinvestment in their activities. Two, by borrowings, where they can borrow from other companies or from other organizations to help fund their projects. Number three, we have investors, and these are people who are on the outside and they are willing to invest their monies into the company for the upstart of a new project, a new good, a new service, or for the upscaling of an existing good or service. And these investors, they expect a return on their investment in profits. Number four, we have equity financing, which comes from the sale of shares or stocks from that company. Number 5, we have debt financing, which can be in the form of bank loans or debt debentures. Why financing choices of a social enterprise differs from that of a commercial enterprise? Well, for one, the social enterprises do not function on the basis of for-profit like traditional businesses. Instead, they function solely or mostly for the provision of societal benefits through their funding. They do not have a typical business structure that's geared towards profit generating activities where they produce goods or offer a service for personal profits. In addition, any surplus in income or funding is often redirected into their ongoing projects or a new project that's going to be for the benefit of society. The social enterprise is geared towards social change and social investment. It is never for the personal gain of shareholders or stockholders or the employees. That's not what it's for. On the other hand, the commercial enterprises, they function off the basis of being for profit like any other typical business. As we know, the definition for a business is an organization that exists to provide a good or service for a profit. And that is not so much different from a commercial enterprise where they function for making a profit. And they will engage in activities that can earn them that profit. So these companies, they will often make goods or have an organization that's built around producing those goods and providing those services. More so, a commercial enterprise can use their profits and income as a means to leverage and acquire additional financing from internal and external sources. More so, commercial enterprises have the ability to be privately and publicly owned, which means that they can have their companies on any stock market and get additional funding through the sale of their shares or stocks on those markets.
In conclusion, financing is important to all organizations, despite the management structure, the size, and objectives of the organization. It allows the business to form and sustain their enterprise. It allows the company to purchase offerings out of their reach and helps companies to take risk and grow. It is important that organizations understand the financial sources that would be willing to extend credit, invest, or donate money needed by the enterprise, the amount of finance which could become available, and the expectations of such persons or institutions. By understanding this, a company will be able to choose a financing source that best suits the needs and position of the organization. We thank you for your time, Ms. Bahar, tonight as we present our findings on financial choices. Thanks again. Have a good night.